In a time of crisis, most assets suffer a dramatic drop in return. Nevertheless, every situation of crisis is unique. The types of asset classes that provide protections to investors in times of crisis varies. For example, during the dot-com crash in 2000, the Nasdaq Composite lost up to 78% of its value, falling from 5,047 to 1,114 points. The returns of large-cap stocks, small-cap stocks, private equity, and international stocks plummeted by -40%, -35%, -25%, and -47% respectively. However, real estate did well during the dot-com crisis. REITs, or Real Estate Investment Trust, which are the securities that invest in real estate and are traded on exchanges like stocks, increased in value by up to 50%. Besides, bonds also did well, rising by 20%, while the gold remained broadly unchanged. When it came to the subprime financial crisis in 2008, most assets crashed. The worst one was real estate. The return of REITs plummeted by -64%. One investment stood out during the 2008 financial crisis. It was gold, with a price increase of 16%. As you can see from the above example, real estate did best among asset classes during the dot-com crash, but did worse during the subprime crisis. Gold remained unchanged during the dot-com crash, but earned higher than other asset classes during the subprime crisis. Therefore, there is no such an investment or asset class that can always protect your investments in a financial crisis. The most important way to withstand a financial crisis is a prudent portfolio diversification. Lower correlations between assets gain better diversification benefits. It enables you to offset the negative performance of some asset classes with positive performance of others during a crisis. However, in times of crisis, assets that under normal conditions are not correlated suddenly become highly correlated, meaning all fall, and very few assets become risk havens, e.g., for example, U.S. Treasuries, gold, Swiss franc, UK gilts. Furthermore, even sovereign bonds cannot be viewed as risk-free investment, particularly in times of low interest rates. It is expected that particularly long maturity bonds will suffer considerable price reductions as yields move up.